the big countries of the world will be forced to do some kind of a monetary reset. And gold and silver will be much higher when that happens. So, until that happens, gold and silver remain in a bull market. The numbers that we'll start seeing for gold and silver will be dramatic compared to today's numbers. You could easily see $15,000 an ounce gold and $200 an ounce silver as this plays out. So the bull market doesn't stop until we start seeing real carnage in the currency market and dramatically higher prices in the precious metals market. So I'd say we've got years for this to run.
Global currency structures are rapidly deteriorating as sovereign debt burdens across major developed nations climb toward entirely unmanageable territory. Relentless deficit spending continues to debase fiat purchasing power, making a systemic global monetary overhaul completely unavoidable. John Rubino, a respected macroeconomic strategist and financial author, outlines that this historic tangible asset bull market possesses years of explosive momentum ahead. Recent market pullbacks reflect natural seasonal consolidation rather than the onset of a bear cycle, particularly as precious metal miners deliver record quarterly cash flows and clean balance sheets, as fiscal instability deepens. Valuations will shift dramatically. Gold is predicted to skyrocket to $15,000 an ounce, while silver is forecasted to surge up to $200 an ounce as the sovereign debt reset plays out. Physical metals and mining equities represent vital wealth preservation against runaway monetary debasement. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold and silver had phenomenal runs from 2024 through 2025, and then they corrected in 2026, which is totally to be expected. You don't get a big move like they had without some kind of a correction, because a big move creates so many profits to be protected and leads to a lot of selling. So we had that. And then we were in the summer doldrums, like you said. The weak time of the year for precious metals is usually the summer. And now we're in August, and we're leaving the summer doldrums and moving into the stronger seasonal part for precious metals, and they're starting to behave better. So far, so good. Everything is behaving naturally in the precious metals market. And meanwhile, the mining companies are doing great. They're reporting excellent numbers. Their second quarter cash flow for a lot of them was almost as good as first quarter, which was just off the charts. And they're using a lot of the money that they're making now to improve themselves one way or another. So the mining industry is getting much more healthy. And the shares of the miners, since they've corrected along with gold and silver lately, look like they're in a good range for accumulation right now. What's going to happen in the next few months? Because just about anything can happen externally to a market or internally with individual companies and things like that. So I wouldn't go out on a limb and say gold and silver have bottomed and they're going up from here, definitely. But it looks good. They're behaving well. And, the miners will tend to make a lot more money if gold and silver just stay where they are right now. That's all they have to do for the mining companies to get richer and richer and their stocks to be more and more attractive. So, yeah, there's no way to predict with any kind of certainty where we are, but I think in the short run, things look good. And in the longer run, things look great because the fundamentals that gave gold and silver their big run to begin with haven't changed at all. Every major government in the developed world is borrowing too much money, and the interest cost on their debt is starting to go parabolic. And they, in most cases, have no choice but to lower the value of their currencies. In other words, debase their currencies, engineer rising inflation in order to get out from under their debt. And that's an environment that's phenomenally good for gold and silver. So I think the basic fundamentals tell us that this correction that we've just seen was not the beginning of a new bear market, and it should be resolved in a bull market direction going forward. The Iran war has disrupted a lot of different supply chains. And that kind of uncertainty, in other words, agriculture fails here and energy is disrupted over here, that's usually good for gold and silver just because the metals are places that we tend to hang out in when there's uncertainty otherwise in the world. And what was the first thing you said before the war? You said something.
Also the Fed.
Oh, the
Focus on the
Fed. Yeah,
Fed.
of course. Yeah. Yeah, we have a new Fed chair here. And there was a job interview involved in him getting the job. And that interview involved the president or one of his surrogates saying, we need lower interest rates. You get that, right? And then the future chair of the Fed saying, of course, I'll give you lower interest rates. So the new Fed is coming in with a bias towards easing. And there are so many potential crises out there that even if they wanted to tighten, something is going to happen that forces them to ease. In other words, we'll have a trouble in the, for instance, private credit market, which is a bubble waiting to burst, and the AI market, which is an even bigger bubble waiting to burst. And when something like that happens, that affects the economy, which in turn leads to an equities bear market, which normally forces the Federal Reserve and the other central banks to start easing aggressively. So whatever the crisis is that we have in the next year, it's going to be something that the Fed is going to respond to with easier money. So I think there's virtually no doubt that within a year that we're in some kind of an easing cycle. And that even if the Fed would like to raise interest rates in the short run, it's not something they're going to be able to get away with longer term, just because so many things are potentially waiting to happen out there that's going to force the Fed to start easing. The world's fiat currencies are still functioning. They haven't been completely destroyed yet. And that's really part of the process. We've got to continue. Well, we don't have to, but we will continue to borrow huge amounts of new money. And that will force us to continue to inflate away our currencies until that becomes disorderly. And, at that point, the big countries of the world will be forced to do some kind of a monetary reset. And gold and silver will be much higher when that happens. So, until that happens, gold and silver remain in a bull market. I think, the numbers that we'll start seeing for gold and silver will be dramatic compared to today's numbers. You could easily see $15,000 an ounce gold and $200 an ounce silver as this plays out. So the bull market doesn't stop until we start seeing real carnage in the currency market and dramatically higher prices in the precious metals market. So I'd say we've got years for this to run.
Government spending is generating crisis-level deficits between $2 and $2.5 trillion each year, pumping newly fabricated currency into the economy to manufacture an illusion of prosperity. However, annual debt service costs have already escalated past $1.5 trillion, creating an unsustainable compounding liability. Meanwhile, speculative capital has inflated dangerous financial bubbles across both artificial intelligence equities and private credit markets. As capital inflows into private lending dry up and economic volatility increases, central banks will face unavoidable financial market contagion. Even with short-term intentions to maintain higher borrowing costs, structural strains will compel the Federal Reserve into an aggressive liquidity easing cycle within the coming year. This inevitable flood of easier money will dilute fiat purchasing power even further. Now, let's get back to the interview.
The U.S. government is running massive deficits. We're running crisis level deficits right now, $2 to $2.5 trillion a year. And that involves the government just creating money out of thin air and dumping it into the economy. That's stimulative. And that's what we're seeing in large part right now is, a lot of new money being created, given to people, given to the banks and everything, and they're spending it. So we're getting growth. And we're also, in the middle of a massive tech bubble. Huge amounts of capital are pouring into U.S. AI stocks. And, a lot of them are, they're starting to go public. You saw what happened with SpaceX just lately. They had the biggest IPO of all time. And they went from being a private company to one of the richest public companies ever. And we're going to see the AI companies go public pretty soon too. Now that creates a lot of capital gains, which people will then cash out of in one way or another and spend. And that's stimulative too. So you're seeing that stuff happen. But so much of it is derived from debt. We're borrowing huge amounts of money. and we're spending it, and that makes it feel like we're rich. It creates an illusion of prosperity. But what it really means is that we have to pay off our debts at some point in the future, and we have to pay off the interest on our debt or cover the interest on our debt in the present. And that's already $1.5 trillion each year. You know, we've got massive interest that is building up on the debt, which then has to build up even further to cover the interest, and so on. Something is probably going to happen in the not too distant future. You can't have this many bubbles and this many imbalances without some kind of a crisis happening somewhere, which leads to a crisis somewhere else, and so on. The potential catalysts for the next financial crisis are so much bigger than they were last time around or the time before that. You know, if you look at 2007, which had a pretty good, healthy economy, it seemed. And then by 2008, we were into the Great Recession. And that was just because of subprime mortgages, which was a few $100 billion. And that's all. And that was enough to destabilize the global economy. So now we've got a much bigger private credit market that, by the way, is already starting to kind of tip over. It saw huge inflows of capital for a few years, and now that capital inflow has dried up. So, you know, that's one thing that can go wrong. And then, yeah, the Iran war's destabilization of a lot of different supply chains, that could be another catalyst. So there's no way to know what the catalyst is, but you can say with not certainty, but a high degree of likelihood that something bad is going to happen pretty soon. And it's going to leave the central banks of the world to start easing again. And so anyhow, long answer to the question of what should we do with gold and silver. We should continue to own it. You know, they're going to do fine in a world that's taking on this much debt. And even though we can't know the details of how it plays out, it's borderline certain that precious metals are going to be in a good environment going forward. Gold and silver were correcting pretty hard there. Copper didn't blink. It just kept on going up, so that now it's right around its all-time high. And the reason for that is that the way the world is going implies that we're going to need a lot more copper. We're electrifying everything. You know, electric cars are replacing internal combustion engine cars, and all these AI data centers. Even though not all of them will be built, a lot of them will be built. And that requires more copper. And we're building out the grid in any event because we allowed the U.S. electric grid to get a little bit old and creaky and incapable of handling things like snowstorms and stuff like that. So in any event, we were going to have to build out the electrical grid and really upgrade it, which requires a lot more copper. So there's a stat going around in the industry that in effect, says we will need more copper in the next 30 years than we've mined in the first 10,000 years of human civilization. And there's nowhere near that much copper coming out of today's copper mines. So the price has to go up in order to incent more miners to go out there and find more copper. Well into that process, with copper having doubled in the last couple of years, but we're nowhere near the end of it. You know, I think copper has to go up a lot from here before we generate anything like the new mining output that we're going to need. If it's even possible to do it, you know, it's completely possible that we've picked all the low-hanging fruit in the copper market. And there just isn't that much copper available at any price, no matter what we pay the miners. And that just makes the price of copper go up even more. So I think that copper is a great story. And there are a lot of copper miners out there for us to pick from, and a lot of smaller ones coming online now. And there's also there's at least one physical ETF out there. So there's a lot of ways to play copper. And all of them probably work out in the long run. Copper has become a national security issue for a lot of different countries, where they know they're going to need it. They know they can't run a modern economy and a modern military without it. So they're not exporting it anymore. They're just what they get, they're keeping. And that's happening for some mining countries that want to stockpile because they assume the price is going to go up. And it's happening for a lot of copper users who know they're going to need it. And they don't want to let it go. They want to buy it and keep it. Now you've got the public sector behind the copper price. In other words, the military and a lot of industrial uses that aren't military right now require so much copper that these guys aren't price sensitive anymore. They know how much copper they need, and they're willing to pay whatever it takes to get it. So you're seeing that with gold and to an extent silver in central bank buying for monetary reserves. And for industrial reserves, you're seeing a lot of that in the copper space and a lot of other commodities. So yeah, that's going to be a big story going forward. Which governments have decided that they want to prop up which commodities? You know, we have to remember governments have unlimited printing presses. So whatever they have to pay, they're able to pay it with money created out of thin air. And that only points towards higher copper prices for sure.
Beyond monetary preservation, the industrial commodity sector is experiencing an unprecedented structural transition driven by critical electrification demand. The rapid expansion of electric transport, artificial intelligence computing facilities, and nationwide power grid overhauls requires massive physical tonnage. Over the next 30 years, global industry will consume more refined copper than humanity has extracted throughout the entire 10,000-year history of civilization. Existing global mines cannot deliver such extraordinary volume, especially since easily accessible, high-grade deposits have largely been depleted. Furthermore, copper has evolved into an indispensable national security resource. Producing and consuming nations are actively restricting foreign shipments while constructing sovereign physical stockpiles for military and industrial defense applications. Because modern infrastructure and national defense cannot operate without this vital conductive metal, institutional and governmental purchasers have become completely price insensitive. Supported by sovereign printing presses, public entities will allocate whatever capital is necessary to guarantee uninterrupted physical supplies. Investors positioned in physical commodities and established mining operators are tracking a generational supply shortage that cannot be quickly resolved. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.